Hi, I'm estate planning attorney Mike Smith with Smith Barid LLC, and I'm one half of the estate planning guys. Today I want to talk to you about estate taxes and how your family can avoid millions of dollars in estate taxes when you pass away. Now, the estate tax exemption for 2023 is going to be $12.92 million. So that means if you have an estate that's worth less than $12.92 million, then your family will pay no estate tax at all. Good news, right? And if you're married, then your spouse can also claim a $12.92 million exemption. So you can effectively get almost $26 million through your estate with no estate tax at all. So for most of us, estate taxes in 2023 are no concern at all. But here's what you need to know about estate taxes. There's a catch. In 2017, Congress passed a law that raised the estate tax exemption and will continue to raise it through 2026. But in 2026, we're going to reset back to the levels that we were at in 2017. That level is $5 million exemption, plus it's indexed to inflation. So what we expect when the estate tax resets in 2026, I'm not sure exactly where it'll wind up, but we think somewhere in that $6 to $6.5 million range. That's a significant difference from where we are now, $12.92 million, and where we're going to wind up in 2026. So let's think for a minute about an example of how this might impact you and your family. So if your estate is worth $10 million today, and we assume an average rate of return that is historically what the stock market has had of 10%, then your estate in 10 years will be worth about $25 million. And if we assume that by that time that the estate tax exemption will be about $7.5 million, then you and your wife combined would have a $15 million exemption to the estate tax. Take that $15 million, subtract it from $25 million, and you have a $10 million potential exposure to the estate tax. A 40% rate would represent a $4 million tax that has to be paid by your family when you pass away. So a $4 million bill that'll have to be paid to the IRS. And what happens with estate tax is that the bill is due within 9 months of death. And so sometimes that forces a family to sell assets that it might not be a good time to sell, or maybe they don't want to sell those assets, like a family farm, for example. So you need to put some thought into how can we avoid that. I always say that the estate tax is a completely voluntary tax. Nobody has to pay the estate tax. You just have to plan for it, and you can avoid it if you want to. So there's several different ways that basic ways that we could plan for that. One is that you can make gifts every year up to the annual exclusion amount. So for 2023, the annual gift tax exclusion will be $17,000. So you can give $17,000 to as many people as you want to and not have to pay any tax on that. And your spouse can do that as well. So one thing that you could do is you could create a trust and you could gift $17,000 per beneficiary into that trust, and thereby move those assets outside of your estate so that when you pass away, whatever you gifted into that trust will no longer be subject to that estate tax. So that's option number one. The second pretty simple option that you could use would be to create an irrevocable life insurance trust. Now that's a type of trust that will own a life insurance policy on your life, and when you pass away, the life insurance benefits will be paid to that trust. Because of the way the trust is created, it is not a part of your estate. It doesn't belong to you. You don't have any rights to that insurance policy. It belongs to the trust. Therefore, it doesn't count as part of your estate. And the benefit that's paid into the trust can be used by the beneficiary to pay off any estate tax liability that might exist. So that can be a good way to plan for the estate tax as well. It's fairly simple to create, and then you have a trustee that operates it going forward. So for you, it becomes a relatively simple thing you don't have to worry about once you got it set up and have a trustee managing it for you. Other things that you could do would be charitable contributions. So you could make deductible charitable contributions to a charity of your choice. And then there are also some other types of trusts that are more complex that we could use to avoid estate tax in the right situations. The thing to remember about the estate tax is that it is a completely voluntary tax. No one has to pay the estate tax. You just have to plan for it ahead of time. So think about the changes that are coming up in the estate tax and the way that you could save potentially millions for your family by doing your planning ahead of time. This is Mike Smith with Smith Barid LLC, and I'm one half of the estate planning guys. If you want to find out how we can help your family, click the button below to schedule a discovery call with our team now. I hope you enjoyed that video. If you did, then take a moment right now to subscribe by clicking below and turn on the bell notification so you get notified every time we post up a new video. Right now we're posting 3 videos a week with lots of information about various estate planning topics, so you're going to want to make sure to stay on top of that. Click right over here to watch the next most relevant video about estate planning. Go watch it now.